Yes. So, in the last two chapters, chapter one and chapter two, we would have discussed, what is the scope and what do we do? How do we calculate and pay top-up taxes? That was all about the charging mechanism. But if you remember, in the charging mechanisms, the first step was always globe income, right? Then we will find the adjusted cover taxes. We'll divide adjusted cover taxes with globe income to find the effective tax rate, right? Whether we are a low tax constituent entity or not is determined by this division. So let's go into understanding globe income and adjusted cover taxes. The whole of this week, is on computation of that globe income. What are the adjustments? And we have 3.1 to 3.5 where we will discuss all the adjustments in detail. So today we will just kind of bring in a flavor of how globe income is computed. We'll just put the baseline and the basic information that is needed. Okay. Yes. So first chapter is of course the financial accounts. So after completing this chapter, you will be able to identify the correct financial accounts to use as the starting point for globe calculations and navigate the hierarchy of accounting standard options. So today is more about accounting. So if you want to, go into your shoes of IFRS or not just IFRS accounting standards, that would be welcome because you have to think this from an accounting angle because tax angle would be a little lesser today. Okay, with that introduction, let's start. Yeah. So basically, the point here is globe income is also calculated from the financial accounts of the constituent entities. Now, you see, this is predominantly a tax, right? I mean, we would have started it would have made, sense if we started the computations with the taxable income of each countries, right? What is the taxable income as per the corporate tax law? But no, they are starting with the financial income of each constituent entity. Now, what could be the reasons for that? It's because see, if I start with the taxable income of each constituent entities, which is calculated as per their domestic taxes, the domestic tax laws are not very similar. Okay, it's very difficult, very different. It includes a political angle. It includes the culture of the particular country. It involves a lot of factors, and it is completely divergent. But you see, with a lot of advancements which was made over in convergence of accounting standards, the accounting standards of each country is more or less similar. I would not say identical, but more or less similar now. If you know, India had Indian accounting standards, and now we have migrated into Indian account IAS, Ind AS. The reason being that it is more similar to IFRS. So, since there has been already a lot of work which is put on making these accounting standards, the starting point is accounting income and not the taxable income of each constituent entity. Okay, and why accounting income is because it's all similar, right? The accounting is almost similar, but taxes are not. So that is the reason why this is there. So Globe Rules decision to anchor calculations in financial accounting rather than tax accounting represents one of the framework's most significant design choices. This approach reflects a pragmatic recognition. You see, financial accounts are prepared consistently across jurisdictions using comparable standard. It is audited for reliability and it is already available. Whereas tax computations vary dramatically by country, use different bases, and require harmonization efforts beyond the scope of pillar. So, in such a situation, so by starting with financial accounting net income, the Globe framework leverages decades of accounting standard convergence while making targeted adjustments for items where book treatment diverges from tax policy objectives. So, long story short, you would be using the counting books of the constituent entities. You will not look at their domestic tax workings. Okay, just like how you are preparing corporate tax, the first step is accounting income. So, as in Globe also, first step is accounting income. Now, Globe income begins with financial accounting net income or loss. So, that is the basic bottom line or the below the line net income or loss of the constituent entity after tax expense. Okay, this is the starting point. Net profit after tax. Don't the OCI items will not come. The even though it says below the line, but below the line of the profit and loss account. If you're following IFRS, don't confuse this with comprehensive income. It is only like net profit after taxes. Is that clear? Okay, so that would be the starting point, or that would be the figure you will take to find the globe income. Now, you have globe incomes are use entity level accounts and not the consolidated group accounts. Now, has been a lot of misconception that, okay, M&E, as a matter of fact, M&E is a group, right? I mean, it's a global group. Or for scope determination, we were taking the consolidated financial statements ka revenue, right? Now, with respect to calculation of globe income, as you are known the hierarchy before. It's first jurisdictional top-up tax calculation, then entity level, then parent level, correct? So, for finding the jurisdictional level top-up tax, you have to kind of like, have entity level computation. So, globe income use entity level accounts, not the consolidated group account. So, you have to start from the financial accounting net income of each constituent entity. Okay, so these are common misconceptions. We say that globe income uses consolidated P&L. No, use each individual P&L before consolidation eliminations. That's what you have to take. And group adjustments do not matter. Each C's group adjustments must be evaluated separately, and errors that net to a zero at group level are fine in terms of consolidation, but here entity level errors that affect the jurisdiction CTR. Now, what does it mean by like all these? I think it's pure accounting. I would understand that the main point here is you use entities individual profit and loss account before consolidation eliminations. Okay, so all that intra-company profits, intra-company dividends, management fees, all that would be included. It won't be adjusted. And say in case if there are errors, for example, the subsidiary makes a sale to parent entity. So subsidiary records a sale of 750. Parent records a purchase of 750. In terms of consolidation, both the 750 plus and minus would be adjusted, right? So it will not create any errors. But let's say the actual sales made, the value was 75,000. Then it creates a problem at the entity level, because even though the sale value was 75,000, what you recorded is only 750. So just because in terms of consolidation, what we normally do is that a net zero at consolidation we would ignore. Okay, it's basically the same thing, but in terms of individual entities, you have to be very careful. You understand what I mean? Yeah. So the main point being you start with each constituent entity's financial net income or loss after taxes. Clear? Now, which financial okay, if you okay, now you in very very obvious question that you could arise is, okay, I will take the financial net income. But you see, if I am an M&E group and I'm a very large M&E group with subsidiaries everywhere. Say I have in Japan, I have in India, I have in Pakistan, I have in UAE. Boss, they all use different accounting standards. So are you sure that I can use the net income that is used in Japanese GAAP in terms of the Japan entity, or the Singapore GAAP in terms of the Singapore entity, Ind AS in terms of Indian entity? We are comparing apples to, we are not comparing apples to apples, we are comparing apples to watermelons, right? So, in terms of the financial accounts hierarchy, they have given a clarification. So, primary rule is you have to use accounts prepared under UPE's accounting standard before consolidation adjustments. So, basically, in the first slide, we told you that you have to take financial net income of the constituent entity prepared on the basis of UPE's accounting standard. Okay, so if there are different constituent entities, you have to first change it into the UPE's accounting standard. Then you take each of them. Yes. Now, if that is not possible, let's say that, okay, this, that means that now for 25, just to, I've been using Ind AS. Now to convert to IFRS, it is very difficult. it is extremely difficult or it's not reasonably practicable to use the UP standard, then they have told us you can use an acceptable accounting standard or a authorized accounting standard subject to conditions. We will learn what this is, but please understand, if it is not reasonably practicable. Now, how it is not reasonably practicable, it's not defined anywhere. It is something that you have to tell the tax officer, boss, I couldn't prepare using the UP standard because of XYZ reasons, which, you know, is reasonably practicable. And because of that, I am using my own standard. Because of that, I'm using a acceptable accounting standard or an authorized accounting standard. Yes. Any doubts at this point? Okay. Now let's understand the step by step basis, of accounting consolidation on a final basis. So step one is like, you have to find the UP's accounting standard. Okay, let's say UP is in UK, and if it uses UK GAAP or IFRS, then that every constituent entity has to use this standard for globe calculations or finding the net profit before taxes for use in globe calculations. Now, you have to determine CE's financial account. For each constituent entity, use the net income or loss determined in preparing the consolidated financial statements. Don't do any, okay, what is the net income or loss which is consolidated onto the financial statement, but don't, eliminate intra-group sales, intra-group dividends, intra-group interest, management charges, or purchase price. Don't make any consolidation adjustments. Okay, what is the net profit of the constituent entity which you would be using for consolidated books without any consolidation adjustments is what we will be taking as global. Right? Now apply the alternative standard exception. Now what does it mean? I told you, if it is not reasonably practicable to use the UP's accounting standard or recalculate my consolidation profit using UPE standard, then we have to determine using we can use either like authorized financial statement or an acceptable financial statement, right? Now, why would it is not be reasonably practical? It may be a recently acquired entity. We have to file local gap. Our opening balances are in local gap. It's very difficult for us to go back all these years and change. There might be system limitations. Legacy accounting firms cannot produce IFRS compliant reports, or it could be due to materiality. Say the constituent entity is a small entity, and if I now go into conversion, for finding this top up taxes, the cost will exceed the benefit. So all these reasons could be not reasonably practical, but these are just suggestions. This has to be done. See, normally what happens is like, if you're consolidating, then normally you would prepare in UP standard, right? If you have to consolidate your net income with the UP's net, the group's income, definitely you would prepare in UP standards, or you would have taken on this challenge before itself. Are you getting my point? So if it is not reasonably practicable, then you might have found why, or you would have a concrete reason as to why it is not practically reasonable. And the where the UPE files its consolidated financial statement, that entity or that jurisdiction, that company law authority would have actually come back and said, okay, this is understandable, this is fine. So all this path would already have been taken. But if it is not reasonably practicable, then in globe sales you can use either a alternative standard. Now, but you can't just use alternative standard just because it's not practically reasonable. You can use the alternative standard if you maintained accounts. Okay. And you have reliable, and the information that is contained in these accounts is reliable. Okay, maybe it has an unqualified audit opinion, maybe it's reliable, and it conform to permanent differences. So the permanent differences exceeding UR 1 million are to be adjusted to conform to UP standard. Okay, so if you do this, you can apply an alternative standard. Yes or no? Don't worry, we will do a final flowchart to kind of like brush your memory, but this is all fine theory. You can apply, boss, you can apply an alternative standard if it is not reasonably practicable. But the point is, you should have maintained accounts, you should have reliable information, and that maintained account should be reliable. And if there are differences exceeding 1 million euros, then you have to adjust into UP standard. Okay. So what is this 1 million threshold? And I told you, if you see here, it is permanent differences exceeding 1 million. Now, what is permanent differences? We'll all the if using an alternative accounting standard, any permanent difference exceeding EUR 1 million must be adjusted to align with the account UPE's accounting standard. Okay. So, and what is permanent difference? So, permanent difference arises when an alternative standard treats an item differently from the UP standard in a way that will never reverse. So, this is just like the permanent differences that we use for deferred tax accounting. Now, we say that we'll only use temporary differences for deferred tax accounting because of timing difference, but in we will not be accounting for temporary differences here, because end of the day, let's say if there is a temporary difference like depreciation calculation, see, it will all normalize until the life of the asset, right? After the life of the asset, everything will normalize. But in case if there is a permanent difference as to accounting between how UP is doing and if you are using the alternative standard, then if each element, each problem, each difference is more than 1 million, then that has to be adjusted. Okay. So let's say that let's take, if the permanent difference is greater than EUR 1 million, let's say different revenue recognition principle resulting in EUR 2 million variance, then you must adjust to UP standard if you're using an alternative financial standard. If the permanent difference is equal to or lesser than 1 million, no adjustment needed. And timing differences, let's say different difference, no adjustment needed. We'll only be accounting for permanent differences. Yes. Okay. Now, what you have to understand is, you have to understand each differences separately. So let's say that there is a different revenue recognition. It's 2 million. Okay, then you have to adjust. Now there is another thing like let's say you have capitalized a few things which the UP standard say uh, you have to consider as revenue. Now that amount is only 500,000. That you don't have to take it all. No need to adjust. Only those line items, line by line items, which are exceeding 1 million, you permanent differences exceeding 1 million, you have to adjust to UP standard. Okay, if you're using an alternative standard. Now, what I want you to do is, will be, there is a lot of information being given out here and it's perfectly theory. What we will do is, you just understand one by one, and in the end of the class, we'll do a flow chart where we will do everything so that you remember from what we studied. But what I want you to do is, if there is anything which you didn't understand while this is being discussed, then let me know. Okay. So just kind of listen to this and whether this is making sense. The whole hierarchy of how things are done step by step basis, we'll do again. Don't worry. So I told you, you can use either an acceptable standard or an authorized financial standard. Now, what does these mean? Okay, and where are these written? It is written in the Globe Rules itself. So there are acceptable financial accounting standards. Okay. So these are specifically recognized standards that can be used without additional adjustment for competitive distortions. So even if there are competitive distortions, that's fine. You can use these standards. Say IFRS, US GAAP, Swiss GAAP, Australian AASB standards, UK adopted IFRS. These are all like acceptable standard which you can use. But there are another set of standards called authorized financial standards. They are acceptable. You can use them, but you may have to adjust for material competitive distortions on top of the permanent different distortion you're doing for accepting. So, what are these authorized financial statements? Japanese GAAP, Chinese accounting standards, Indian GAAP. Okay, it's India's. Sorry. Swiss Code of Obligations, Irish GAAP, etc. So these things you can use, but you have an additional step more. You have to check for something called material competitive distortions, or MCD, has to be checked. Now, what is this MCD? So, a variation exceeding 75 million a fiscal year between authorized standard treatment and what the UP standard procedure. Okay, so or like so if material competitive distortion is if more than 75 million in aggregate, if you are using an authorized financial statement and it has more than 75 million in aggregate variance with UPs or with an authorized or an acceptable financial statement, then you must adjust to eliminate that distortion. If it is equal to or lesser than it is EUR 75 million, then no adjustment required. So this is additional that has to be done if you are using these standards. Okay. So these standards, there are only three things. Thing is, accounts has to be maintained. If you're using these standards, accounts has to be maintained. Then the accounting information should be reliable, and permanent differences should not exceed 1 million. If you're using this, all three conditions plus material competitive distortions in aggregate should not be more than 75 million. Getting it? Oh. So this is a list of what is acceptable and what is authorized. You can get easily. It's available. Right? So this is material competitive distortions. And I told you don't do any consolidation adjustments, right? So we have to look at the constituent entity level profits. So never do any consolidation adjustments. What are the normal consolidation adjustments? Let's say intra-group sales elimination. Don't eliminate. I mean, we don't need the we have to do jurisdictional top-up tax analysis. So don't do the mistake of eliminating all these things. So Globe uses pre-elimination accounts. No need to eliminate intra-group dividend, intra-group profits in inventory, or goodwill amortization and impairment you have to include. Purchase price allocation you have to include. Currency translation adjustment. See, translation, it's not transaction. So translation normally comes in OCI. You have to include it if it is part of P&L. Okay, if it is OCI, don't include. And minority interest share, you do not deduct. Please do not deduct minority interest profit in your Globe income, because you know that it is handled separately in top of tax allocation. Because we will be using something called inclusion ratio. So do not deduct the minority share interest and all from your Globe income. Whatever is the Globe income for that constituent entity during the year has to be taken into. So don't eliminate any do not eliminate any consolidation adjustments and the minority interest share also. You have to include the full amount as Globe. Now you tell me, what did you understand all these things, like goodwill amortization, impairment, and purchase price allocation? No? Yes or no? What is purchase price allocation? What is purchase price allocation? Okay. So if you just rewind and remember consolidation. Okay. Now consolidation, what do? We have to calculate goodwill, right? Or bargain purchase. So while calculating goodwill, how do you calculate goodwill? Do you consideration minus? Do you use net book value of financial assets? Net book value of financial assets or fair value of financial assets, which one would you use? If you are removing, whether you would use for consolidation of a subsidiary, whether you use, yeah, so I'll say we use fair value, but the book value would be different, right? What is accounted is different. So in such a case, those purchase price has to be allocated. So you would be having the fair value of the assets should be used, not the book value in the acquirees accounts. That's what it means. And also, if you are using fair value against the book value, wouldn't there be a goodwill that will be? So in case if there is an amortization or impairment of goodwill, that also adjustment has to be captured in the subsidiaries consolidated entities books. That's what it means. So basically what they are saying is, do not eliminate all consolidation adjustments, but these two things you have to include. Okay, so it's a little subtle there. Are you understanding? So whenever you are given a financial, whenever you're calculating P&L, you have to see if Fair value adjustments and goodwill amortization should also be a line item in your P&L. Now, with respect to materiality, now there is no separate materiality for globe calculations. Uh, whatever is material for consolidated accounts purpose, it remains immaterial for group purpose. But we learned that small adjustments no need to calculate, but alternative standard differences, I told you, 1 million threshold for permanent differences, and you are 75 million aggregate threshold for material competitive distortions you have to take. These are the only materiality level. And entity level errors, I told you, entity level errors may be immaterial at group level, but material at the entity jurisdiction level. So you have to consider that also. Apart from these two, you don't have to kind of like, stress on any materiality things. Okay. Now, before we go to common pitfalls, let's do a little review of what we did. Yes. Just so that we are all on the same page. Yes. Yes. Okay. So how do we see what were we learning? We were learning the what is the starting point? What is a starting point? What is a starting point for globe calculation? Starting point is net profit after tax. Okay, this is net profit after tax. Now you tell me, this is what we started with, and then I told you, like, the major thing was which accounting standard to use. Correct? Because okay, I will take net profit after taxes, but different constituent entities use different accounting standards, so would it be same? I told you no, you have to first use the UPEs. You have to first use the UPEs accounting standard, right? You have to use the UPEs accounting standard. Now, is it practicable to use? Is it practicable to use UP's accounting standard? If it is, yes, and if it is no, let's understand. So, is it first question you have to ask is whether it is practicable? Are you with me? Yes. Now, if it is practicable, then what? Then it's pretty simple. Use UP's accounts. Use convert and do. Oh, let's make it simple. Use UPE's standard, right? Now, if it is not practicable to do, what did I tell you? If it is not practicable to do, you have to ask few questions. Okay. What are the questions you have to ask? Is accounts maintained? Yeah. Is the accounts reliable? And then, is there any permanent difference? You have to find it, right? And if we'll say here no permanent, if there is no permanent difference between of more than 1 million, then you can go ahead and use your fraction. If the Okay, I have a question. Okay, if the UP's accounting standard is neither acceptable nor authorized, it is a wide list. It is very difficult not to get not acceptable or authorized. As long as all C's follow UP's A's, it is fine. Yes, absolutely. Absolutely. That is the first line of things. If you can do UP's accounting standard, then khatam. Yeah, so flow chart, if it is no, then you have to answer these three questions. Okay, is accounts maintained? If it is all yes, if it is all yes, okay. Now, if it is all yes, then you have to now use your accounting standard. You have to then see whether your accounting standard is acceptable or authorized. Okay. If it is no, then you have to do it in UP's accounts only. Okay. If these three are like, making sense, then you have to use acceptable or authorized. Now, if it is acceptable, we'll do two lines here. If it is acceptable or authorized. Now, let's say this is acceptable and this is authorized. If it is acceptable, then what you should do? All the permanent differences more than 1 million to be adjusted. Yes, if it is acceptable accounting standard, like IFRS and all, then you have to all the permanent differences more than. So I understand your question here. I wrote no permanent differences. It says permanent differences more than EUR can be adjusted. Okay. If it is can be adjusted, then you have to first see if it is acceptable or authorized. If it is acceptable, permanent difference of more than 1 million to be adjusted. If it is authorized, then apart from permanent differences of more than apart from permanent differences of more than EUR 1 million, check for what is that competitive material distortions in aggregate of more than 75 million and adjust. Yes. So this is the flow chart if you want. Okay. So I will write one more for clarity. If it is neither acceptable nor authorized, then you have to use UPs. Let's say it happens because there are a lot of Islamic financial statements and all comes. So let's put them clarity there also. So if it is accepted, neither accepted or authorized, then you have to use UPs. Is that clear? Your question, Melvin? Is this flowchart okay as to how to find the accounting standard or which accounting standard to use? Because this is the only thing, which had a lot of information there. Yes. Can we move on? And after this, I also told you that, all the, I also told you that, consolidation adjustments has to be not adjusted. Like, do not adjust or we'll have two of these. Okay. What are the things that you should do not adjust? Do not adjust for intra group sales, purchase, dividend. Okay, dividend would be adjusted later in the computation if you see. Intra-group dividend, then there would be like management fees. All these would be like intra-group profits, intra-group unrealized profit on inventory, etc. All these things like normal consolidation adjustments do not do. We have to see the consolidated entities amount in such a way. Okay. Now, why would they say not to do this? Let's say that entity is like we have transfer pricing rules to check that from a domestic point of view. But if there is intra-group purchase and sales and intra-group low tax, the profit is concentrated in the low tax entity, and if we remove this item as a consolidation adjustment, then it will never get taxed, right? The whole purpose of this is that 15% tax goes on an all-round basis. So never remove all these things. Don't by heart, just understand why. If I remove all these things, then these things will never get taxed. So it is not my interest. I mean, I have to collect 15% everywhere. So and constituent entities level, you have to include all these things. But they want to capture real profit. So what they have done is all the goodwill amortization and impairment as well as purchase price allocations must be made. We will go into that while going into the next things, but this is the on a very bird's eye view, this is what we discussed today. Is it clear? Yeah, minority share also do not after you find the profit, minority share should not be removed. Fantastic. Because why are we not removing minority share from the globe income time? Because there is at the time of allocation, it would be automatically set off. We will be finding an inclusion ratio. Yes, today's topic clear. The starting point of globe calculation. Yes. So we'll meet tomorrow for the remaining. Like what are the after you find the globe income after these adjustments, what are the other adjustments which would come? So we call this as mandatory adjustments. We will come to that tomorrow. Okay. Okay. Thank you.